All right, investors. 6 months ago, I made a video on Google shares. You can watch the video. I will place the link down to this video in the description section. And also you can look at the top right side of the corner. You can click and watch the video. Back then I said that the stock can reach the 204, and indeed in 3 months after publishing the video, because I published it in November, and after I published this video, the stock went up and hit 204 in February, and then it started declining rapidly. This was the consensus target price over here, and I said that it can overpass this resistance level over here, and then it can decline, and indeed the stock started declining after reaching this level. So if you watched my video and opened the position somewhere in November, you could have gained 20%. Now the 6 months have passed, and it's time to record another video on Google shares. This time, let me calculate the stock target price using the DCF valuation model. You would need the Google Sheets and FMP to get financials, Google financials. This would be useful to populate our DCF model in Google Sheets. I will show you everything step by step. And then we'll try to forecast the shorter term price for the share, where it can head, where it can go. So let us start our current video. So currently, today is the 27th of May. The stock is trading 171.49 over here. And let's start with the Google Sheets. Here you see the template. So what you should do, you should connect the financial modeling prep data to Google Sheets. I will place the instructions in the description to this video. So read the description to know how to connect financial modeling prep endpoints, financial modeling FMP data to Google Sheets. After you've done those connections, just go on the empty cell and use this formula equals FMP advanced DCF A1. A1 is the cell with the Google over here. So if you click on the formula, this thing is highlighted Google, and then hit enter, and now it downloaded you the forecasted data starting from 2020 to 2029. This is the forecast of revenue, forecast of EBITDA, forecast of depreciation, total cash, and different things that we would need for our model. Don't worry, I will go step by step and you will understand everything. Then let's go to another table with assumptions. You should create the table with assumptions. The discount rate, or WACC, this is the weighted average cost of capital. This is the average cost the company is bidding for supporting its equity and supporting its debt. In our case, it's 871. How we did these calculations? Again, from this table over here, you can see the WACC number. Just copy this WACC number from here. I've taken the average number, and it's 871. Then this is the perpetual growth rate. This is the consistent growth rate. Again, I've taken it from the table that we got using the FMP endpoint. As you can see, AN4, this is the long-term growth rate, which is equal to 4%. Also, the last year EBIT is the G4. You can see from here it is G4. It's earnings before interest and tax. Again, I'm taking the G4, so this is the last earnings on the forecasted date. Then I'm taking the last year depreciation and amortization, percentage of EBIT. So basically I divide AI4 by G4. You can see it's depreciation. I divide by the EBIT, and I get 17%. Then enterprise value to EBIT multiplier, you can also see here the formula. I take the averages of AQ and averages of E. So AQ, this is the enterprise value. I take the averages of enterprise value divided by the EBITDA. This is E table. This is the EBITDA. I simply take the averages. So the next step is transaction day. This is the formula equals today. I assume so that we want to buy these shares today. And the fiscal year end, different companies have a different ending of the fiscal year. So for Google share, it is the 31st of December 2025, but this is not always the case. The current share price is input B18. This is the current share price. Over here, again, I'm using the formula FMP equals FMP real-time price A4. This is the Google to get the real-time price, which is 171.43. And I'm getting the live price. Again, the shares outstanding W13. I take it from here, W13. I've taken the last known shares outstanding. And then I take the debt and I take the cash again from the same table. You can find here the debt and you can find here the cash. You can see the formula AD9 is for the debt. It's a total debt. And for the cash, I'm taking K9. So for the cash, I'm taking K9. This is the cash. I'm taking this one, the cash amount from here. So the next step would be to make the forecast. I'm making the 5-year forecast of the free cash flow. This is the time periods. It's a 0 because we're buying today. It's 1 year from now, 2 year, 3 year, and 4 years from now. And here you can see different periods for fiscal year ending. We can just correct this date, put here December. So let's say 31st of December. The same here, 31st of December. Just let me copy this thing and do like this. Yes. Now the year fraction, this is the formula, this is the entire year, entire year, that's why it's 1. And this is 061 because we bought it not at the beginning of the year, but on the May. That's why it's a fraction of the year. As you can see, there is a formula. So you can take when the year ends minus the current date, divided by 360, and you get the year fraction. This is just a formula. Then we forecast the free cash flow. As you can see, I have the formula here. So the current free cash flow plus 1 multiplied by 1 plus 5%. So 5%, I assume that the free cash flow for the company will be growing in the pace of 5% every year. So 5% cash flow increase every year. This is the free cash flow, the cash that is left from the company after all the outflows and inflows of the cash. So this is the net cash that is left from the company that the company can use for its business. Then what we do, we should discount this free cash flow. So as you can see, I'm discounting this free cash flow by this discount rate 8.71, which is the weighted average cost of capital. I discount for every year. So for the current year, the formula is we basically take this free cash flow divided by 1 plus this discount rate. And here is E19 is the time period. So it's a 0 because we bought it today. And for the next year, the cash, the formula is divided by in the power of 1. And in the second year, the same. We take a free cash flow divided by 1 plus this discount rate in the power of 2. The formula broke a little bit here. I'm so sorry. So it should be D4. This one, and let me take this pressing function F4 key so that this field is not moving anywhere. So now we forecast, like for the second year, we take this free cash flow divided by 1 plus 878 in the power of 2. For the fourth year, for example, we take this free cash flow divided by 1 plus 878 in the power of 4 because it's a fourth year. So we discounted all those free cash flows. The next step would be to calculate the terminal value. As you can see, for calculating the terminal value is here. You can see the formula for calculating the terminal value. It's the average between the perpetual gross and enterprise value to EBITDA. So the formula is over here. You can examine this formula very carefully. So we take AI 23, which is the last free cash flow that we know over here. I mean, it's our last known free cash flow that we forecasted. Then we multiply it by 1 plus the perpetual gross rate divided by discount rate plus minus the perpetual gross rate. Plus minus because this thing can be a negative sign, but we need it positive. So that's why it's a plus minus. And then enterprise value to EBITDA is calculated using this formula D8. So D8 is the enterprise value EBITDA multiplier multiplied by the D6, it's a last year EBIT, plus open the parenthesis, last year EBIT multiplied by the last year depreciation and amortization percentage of EBIT. So you can memorize this formula so that you create this formula yourself later. And then we get the average. So the formula is straightforward. You simply take this average, and this is the terminal value. Then we also discount this number over here, and the formula is straightforward. So the terminal value plus 1 plus this discount rate in the power of 4 because we forecasted for 4 years in advance. Then the last step would be to calculate the enterprise value. Not the last step, but almost the last step. The enterprise value is the sum of all those forecasted free cash flows. So if you add all this up, you will get the enterprise value. I'm just taking this formula for the forecast. Then you add the cash that we've extracted here from the FMP endpoints. Then you take the debt, and equity value is equal to enterprise value plus cash and minus debt. And you get the equity value. Then from this equity value, you basically divide this equity value by the D12. It's a total shares outstanding that the company has, and you get the forecasted share value based on the DCF valuation model. So based on our assumption, based on our forecast, based on our 5% growth rate of the free cash flow, based on our 4% perpetual growth rate and 8.78% discount rate, the equity value is 262.87. Let me return back to my table over here. So the current price is 171, which means that the gross potential for Google share is 53% from the current level. Now let me return back to over here from the current level. Let's take the 53% gross. Let's make it something like this. This is more longer term growth. If company fundamentals won't worsen, the company, of course, can reach that level. But of course, you should regularly monitor the financials, fundamentals. If they worsen, then you should correct your model. Maybe the target price would be lower. So the target price that we calculated is 262, somewhere here, yes, 262. So the stock can reach that level within a year or maybe more if the fundamentals won't worsen. If they will get better, the stock target price will rise. But up till this point, assuming that the company will be posting this data, because these are the forecasts in advance, assuming that the company will be in line with the expectations on this data, then the target price can be somewhere here. But if on the next quarter or on the next reporting date, the company will show worse than expected, for example, the EBIT number, then we should make certain corrections to the model. We should lower the EBIT number and so forth. We should make the corrections and our model will look differently. But up till this point, the stock target price is somewhere here. Now the next step, let's calculate, which implies more than 50% growth potential from the current level. Now let's use another application called Stock Analyzer. This is not the application, it's just a Chrome extension, Stock Analyzer. Just download it from the Chrome Web Store and input your custom API key. Input the stock ticker. Hit the calculate button. As you can see, the app calculates using the DCF model, but it has more conservative assumption. The stock target price is 211. So we can also put it here, but we are here not for this target price because we calculated using our custom model, using DCF model with our custom assumptions, and we are here for this stop loss and take profit levels. So stop loss is 159, and take profit is 190. 159 and somewhere here. So let me change the color of these lines a little bit. Let's put it blue. The same color. So the stop loss level is 159. That means that if the stock will reach that level and goes beyond, you should sell it from here, and the take profit is around 190. So if stock reaches that level on the shorter term within couple weeks or couple months, you can sell it from here. How these levels are calculated? If you're buying from the current level, of course. This is just a standard deviation. I take the stock price and minus 2 standard deviation. This would be a stop loss. And I add 3 standard deviation to the current price. And this will be the take profit, the approximate level where the stock can go. But I would sell it somewhere early if I'm a shorter term investor at as soon as it reaches somewhere 185, as it's close to its resistance level somewhere here. So there is a probability that the company can go here if the negative news would prevail. Of course, for tracking and monitoring some news surrounding the company of stock target prices, you can use the stock news and forecast extension. Just input your custom API key. You can get it here. Then you can input the stock ticker over here, hit show analysis, and you can read the most important news surrounding the Google company. If the news are negative, be very careful opening the position because the stock can go lower. It can go lower more aggressively right now given low investor confidence. Then you can also look for the estimates for the company, choose the quarter period, and then once you hit the show analysis button, you see the revenue average forecasted by 90 analysts and EPS average 223 forecasted by 28 investment analysts. So if the company will report better, the stock price can go higher and can skyrocket and even cross this resistance level. So you should monitor the prices closely. The next step, let's see the target prices calculated by top investment analysts. You see the most recent price is 185. Next, someone calculated it as 190. So there are different analysts, 160. But I would say that the average price is somewhere around 190. So the analysts believe that the stock will go somewhere close to 190. And indeed, this is our take profit level. Level at which we can sell. This level was suggested by the stock analyzer Chrome extension. And as soon as you go to this level, you can sell this stock on the shorter term, but again on the longer term, if you like the share, because fundamentally it looks very strong, you can wait and sell at the 264. By the way, fundamentally, this stock is very strong. If you want to take check stock fundamentals really quick, you can download the Stocks to Buy iOS application that has great different screens for that can provide you short-term and mid-term trade recommendations. For checking company fundamentals, open the app, register, confirm your email, log in, and go to stock type screen. And on this screen, type the stock ticker Google, G-O-O-L, hit the analyze button, and you can see the Piotrowski score, you can see the dividend yield, you can see the stock growth potential, the most important fundamental things to check if the stock is strong fundamentally. The Stocks to Buy app also has a candle analyst screen. You can input the stock ticker, hit the refresh button, and you can see when is the best time to buy the stock intraday. So if you're making a lot of deals intraday, if you're an intraday trader, you can check this stock analyzer screen that analyzes Japanese candlestick patterns, and based on those patterns, it tells you when the stock can go lower, when it's the best time to buy or sell the stock. It is making its assumption regarding the trend direction. So you should basically definitely check this up, and it also gives you the midterm trade recommendations. If you go on the main screen or input the stock ticker, and then you can see the social sentiment, how people, different crowd, what people think about the stock. If the sentiment is more than 0.5 or 50%, that means that majority of people are positive about the stock. If the sentiment is something, for example, 0.2, it means that only 20% are positive about the stock, mentioning it in a positive key, and the stock can go lower. So you can definitely check those screens and see the investor confidence, track the investor confidence. You can also check the analyst rating using the Stocks to Buy app, and the app assigns overall rating based on 3 important indicators. The rating can be hold, buy, or sell. So you should definitely check this application app. But based on what we see, the short-term selling point can be 185, longer-term selling point can be 264. But if a lot of negative news will prevail on the market, the stock can go till 160 and be even beyond. But the selling point with the take profit, with a stop loss, could be 160. Thank you very much for watching this video. I will place the link to all the app down to the description of this video, so you can definitely check those application app. And please keep in mind that it's impossible to forecast the share price accurately, as there are a lot of factors that come into play, and sometimes the factors are contradictory in nature. That's why be always careful when analyzing the stock. But if things, because unexpected things can happen, okay? The company can post towards unexpected earnings, the corporate scandal can happen, the stock will decline, drop hard. But if it's a fundamentally strong share, which you can check with the Stock to Buy iOS application, the stock will always rebound very fast. That's why it's important to hold fundamentally strong shares. But why we do this forecast then if we cannot forecast? We do this forecast if things will stay normal, the same as now, without any shocking moments, then the stock will move as we forecasted. But please keep in mind that shocking events can happen. We never know when the larger player will start selling, and that's why it's not, or buying, and that's why it's not possible to accurately forecast the share price. If you want to lower your risk, you should use derivative instruments like options, or you should diversify your investments by building an efficient investment portfolio. I also put the link to this video on how to build the efficient investment portfolio. I have a very cool web app called Diverset. It helps you find stocks tailored to your risk appetite, and build portfolio in such a way as to minimize your loss and maximize your expected return. The app tells you what should be the weight of each asset in your portfolio to achieve that goal. Thank you very much for watching this video. I hope it was useful. Please hit the like button, subscribe to my channel, and check my blog and check my applications. Thank you very much.